Good afternoon, everybody. Here we are. It's Paul here for on Monday, the 12th of November, for I think what is session 16 of Mastering the 4 M's of Trading by myself, Paul Wallace, a trader, analyst, and coach. It's great to have you here with me, whether you're here joining me on the day or watching this on demand. As always, I begin with a quick risk disclaimer. Trading with financial instruments offered by Admiral Markets carries a high level of risk which is not suitable for all investors due to their complex nature. Before entering into client agreement or making a transaction, please make sure to read the terms and conditions of our service. Consult a specialist if necessary to ensure you understand the risks involved in trading. This presentation and the accompanying video is for information and educational purposes only. Online educational materials are developed by Admiral Markets and distributed by Admiral Markets Group investment firms for a global audience. Therefore, please take into consideration that the information in this session may not be suitable for everyone. Presentation and accompanying video should not be taken as advice for investing, as they only represent the personal opinion of the authors. As of August 2018, the regulation within the European Union differs for retail clients and professional clients. In our presentation, we use demo trading accounts where all clients can still use a high leverage in a risk-free environment. Before opening a live trading account, please consider the differences between retail and professional trading terms. Retail clients benefit from an unlimited negative balance protection. Professional clients at Admiral Markets UK receive a compensation of account deficits with the maximum payout of £50,000 sterling as per our negative balance protection policy. Admiral Markets offer a wide range of instruments and products that you can trade. Two of their favorite ones are DAX 30 and Euro Dollar, both of which have 0.8 points or pips spread in normal trading hours. They also provide the both MetaTrader 4 and MetaTrader 5 versions with their old Admiral Markets MetaTrader Supreme edition. If you have any questions or queries, then please get in touch with your account representative. And as always, Admiral Markets is a global brokerage. There might be one world, but they have global offers. They are Admiral Markets are regulated and authorized across the world in various regions. And please get in touch with your account representative, and they will be happy to guide you towards which is the most suitable area for yourself. So, as always, ladies and gentlemen, I'd just like to set expectations for our session. For me, it's about educating you on the 4 M's of trading so you can go away and analyze any market and be ready to trade it, and also help raise your self-awareness about managing risk and about managing yourself. For yourself, ladies and gentlemen, I know that we have a wide range of experience in the room who join us for our sessions. I also appreciate that, we have time limitations of 45 minutes, so that I can't always go into the depth on topics that people might like. But what I will always try and do is give you some tools that you can use tomorrow in your own trading. And that's the whole sort of raison d'etre for these sessions, is that, to teach you about the 4 M's, but also provide you with tools and concepts that you can take away and use the very next day. So, you should be aware by now, if you're joining us or watching us on demand, that the Mastering the 4 M's of Trading is all about you being able to understand and master those 4 M's of trading: markets, method, money, and myself. Because when there's a sweet spot occurs, when a trader, is actually on top of all of those 4 areas of trading, and that invariably is when they tend to sort of deliver the best performance. So, we talked about right from the start that, as part of that, part of mastering the 4 M's of trading, one of the things you can do in terms of managing myself, is about having simple little processes that you can follow that generate the correct trading habits and behaviors. And, we've talked about it for the last few months, about step 1, define levels of support resistance. Step 2, define if there's a trend. Step 3, wait for price to react at key support and resistance levels. Step 4, look for those price action signals at those levels. And step 5, check, is it part of a bigger chart pattern? So, for the last few months, we've been focusing mostly on markets and method, but, what we'll be doing after next week is actually moving on towards focusing on money in terms of the risk management side of it. And throughout all of these sessions, there is always a little bit of a managing myself element towards them. But actually, as we move into the new year, we'll be focusing primarily on that fourth M, the managing myself. So, what we've talked about, okay, and what, if you're just joining us for the first time, is, I try and do a very, very quick recap of what we've gone through week on week. And the idea behind that is that, the more you hear and understand these concepts and ideas that I'm sharing with you, the more they kind of sink into your sort of trading psyche, and they become your particular trading beliefs. They become your trading habits and behaviors. And that's what I'm actually looking for. As we go through some of these trading methods, if you want to go into them in more detail, well, then just go back and find the sort of specific sessions there. They will be on the Admiral Markets YouTube page or on the Admiral Markets Facebook page, and you'll be able to find the recordings of the previous sessions. By all means, go download them and watch them if you want to get the specific detail on a particular method. What we talked about, okay, and hopefully then most of you will have realized it by now, is that, it boils down to one of two styles when we're talking about trading and investing methods. You're trading either a break of a line of support resistance or a bounce off a line of support resistance. And, it really is about as simple as that. And, I talk about it every week. So that, human beings, and myself included, we try to overcomplicate things. And actually what we need to do is just to sort of boil it down, just to understand the sort of simple, basic, fundamental concepts, and we can build from that. So if you remember, one of the first methods we talked about was, trading the pin bar or rejection candle. Okay, if you remember, very simple. Pin bar must have, a open and close within the previous bar, candle width 2 to 3 times the length of the body, a long nose protruding from all the other bars, okay, and better pin bars stick out. And it's a very popular sort of, let's say, trading signal, okay, step 4, very popular, and you can find them across all time frames and all instruments. So, once again, that's what I say in terms of, the concepts and ideas and tools and techniques and tactics that I share with you. They're all about what I would call being time frame and instrument agnostic, okay? I don't really care whether you trade, gold on the monthly chart or whether you're trading euro dollar on the, the 5-minute chart, all right? These ideas and concepts work across all instruments and all time frames. So that was the pin bar that we talked about, okay? We talked about pin bars because, the reason we're interested in it is because it shows rejection of a particular area or direction. Private trader, don't try and fight them, work with it to show the likely short-term direction, and ideally look to sort of trade with the trend. That's what we've been talking about, to focus on to begin with. We've been talking about, positioning ourselves as sort of a longer-term sort of swing trading, end-of-day trading, looking where possible to trade with the trend, but also realizing that very often, we have some very nice setups on reversals. But primarily, we're ideally looking to just find a trend and try and trade with it. So after that, we looked at the engulfing candle. Okay, not quite a rare setup, all right. But when they do happen and they happen in the right context, they can be very high probability because it demonstrates total psychological overwhelm of the existing trend. They are a reversal pattern, so we look for them at the ends of trends. We're looking for a bullish engulfing candle at the end of a downtrend, and we're looking for a bearish engulfing candle at the end of an uptrend. Just keep that in mind. That's where we want to see them. We want to see them at the end of trends, and we're looking to trade in the direction of the close of the engulfing bar. Remember, then we looked at a 3-bar reversal. Okay, just a very simple trading tactic to allow you to join an existing trend. Just, based upon the sort of similar the steps that we have been following. Okay, to find if there's a trend, look, wait for a pullback to support resistance, and then once we do that, our trigger becomes, 3 bars. All right, a 3-bar reversal, of which we need 2 seller bars followed by a buyer bar. Okay, in an uptrend. Or in a downtrend for short, we need 2 buyer bars followed by a seller bar. Very, very simple, very simple mechanical trading idea. That's what we're actually looking for. Very simplistic, so in a setup, in a long trade, you're really looking for a price to sort of come back to one of those levels of support resistance. 2 red bars followed by a green bar. And if that 3rd green bar is, an interesting candlestick that we've talked about, okay, things like pin bars, engulfing candles, inside bars, spinning tops, etc. That just gives us more confidence. That's what we like to see. So after we did that, then we looked at inside bars. Okay, remember an inside bar, it's the opposite of an engulfing candle because the high and the low of the bar is fully within the range of the preceding bar. I tell you every week, think of it like an organism breathing, all right? The markets are like humans, all right? It surges, it rests, it surges. The inside bar is the rest, and we're looking to catch the next surge. Ideally, what I talk about is, look to trade them as sort of at the end of pullbacks in trends. If you're a longer term trader, as we've sort of positioned ourselves to begin with, then you might want to use the 4 hours to execute and manage. You can, beware of some particular false breakouts, which with a little bit of experience, you'll get to understand and see. Can also work in breakouts as well. We wait for a breakout to occur, then you wait for an inside bar to be printed, and then you trade that in the direction of the breakout. It's a very simple, very nice way to actually sort of trade inside bars on a breakout. Very simple, very mechanical way to trade. That's why we sort of shared that as a way and a mean for you to sort of start to engage with markets. Then we looked at key day reversals and momentum reversal candles. If you remember, okay, that a key day reversal is a sharp reversal pattern that occurs during a trend or at the end of a trend. In an uptrend, prices open equivalent or above to the previous day's close. They make a new high in that session, and then it closes below the previous day's low. There's been a real psychological swing in that session. In a downtrend, prices open equivalent to or below the previous day's close, make a new low, and then close higher than the previous day's high. The greater the price range and volume in the key reversal day, the more reliable the signal. Okay, they don't happen very often, but when they do, you want to sort of sit up and take notice of it because it gives you a great opportunity. And what we said, they don't happen as often as they do, but a version of it called what we call the MRC, the momentum reversal candle, which you might hear get called the swing points. That actually does happen a good deal more often. They are much more frequent, and therefore, when they happen in the right context, that in itself can be a useful trade signal. So if you remember, for a long setup, okay, what we're looking for, price is in a downtrend. Price during that session makes a new low, but it actually closes higher than the previous day's close. Whereas a key reversal would close higher than the previous day's high. Okay, giving a very, very strong indication. The MRC only has to close higher than the previous day's close. Okay, and that's that is still in the right context. That excuse me, that is still a very useful trade trigger. Then, if you remember, a couple of weeks back, we looked at combinations between the key reversal and the 1-2-3 pattern. The 1-2-3 pattern is something we're going to touch upon today. What I look about is, after a good trend, I take a bit of an interest when price prints an individual reversal candle on daily and/or weekly charts. So that could be a key reversal. It might also be an engulfing candle or a pin bar or a rejection bar. That's not unusual. You just need to be aware of that. What happens is once that, let's call it that key reversal occurs, then we wait for a 1-2-3 pattern to form, which gives us the lower high, which means we're not really trying to sort of pick the exact top. We're letting the market play its hand, and that's what's good for us. Then, ideally what we'd like to see is point 3 being, a rejection or an indecision candle, and there we can take the trade of that. And I'm going to talk about that in a bit more detail later on in this session. That will be the tactic that we sort of focus on for the remainder of the session, and we'll get to that in a couple of moments. We also talked about, a further option of that is that we have the 20-period moving average should now turn from being support to act as dynamic resistance when a market's uptrend is rolling over. If you remember, we touched upon that last week, talked about using the power of the 20-period moving average. It's actually really key, really crucial. You'll find that there are lots of, let's say, institutional buy and sell programs that happily trade around that 20-period moving average. And that's what we use for our own trading ideas. So then, we talked about, general chart patterns. Okay, if you remember, how on the charts when we sort of draw in our levels of support resistance, we also find that they will create various chart patterns. Those chart patterns themselves can be traded. 2 types of pattern: continuation and reversal. The name, I guess, the name gives away what we're expecting. Continuation pattern, we expect the trend to continue after its breakout. A reversal pattern, we expect the trend to reversal. Very, very simple. Remember, we've talked about, continuation patterns, things like bull and bear flags, ascending and descending triangles, and symmetrical triangles. Reversals, well, we were looking at head and shoulders, double top and bottoms, triple top and bottoms, cup and handle, and island tops and bottoms, which are really, they're more prevalent in stock trades rather than sort of trading big picture FX and indices, etc. Remember, we talked about, a flag pattern. Okay, you can see bull and bear flags. Okay, we talked also a little bit about how, what we like to see, or what I particularly like to see as an edge, is that, at the end of the flag pattern is something like a rejection candle. So it's a confluence of events. That's the thing we're looking for, a confluence of events. That's what makes us happy. We had a look at, continuation pattern that is ascending and descending triangles. It's about price getting squeezed, and then once it blows out, once it excuse me, once it blows out of the let's call it sort of the flat side of the triangle, that's where we're looking to sort of to trade in line with. And we also talk about symmetrical triangles, and I quite often talk about these. I do the real-time daily trading slots there at Tuesday morning at 10 o'clock London time, and you often hear me talk about how where I see charts starting to coil up. Okay, they're getting squeezed, they're getting sort of coiling up, getting ready to make their next big move. So there you go. There's a fair bit of continuation patterns there that you can utilize to sort of help give you a little aid memoir when you're sat in front of charts actually trading away. We also looked at reversal patterns, in particular head and shoulders, double tops and bottoms, triple tops and bottoms. Okay, and, we've already covered key reversals as well. Head and shoulders patterns, well, it's quite self-explanatory in the sense that it looks like a head and shoulders pattern. Classically, we would expect the right shoulder to be lower than the left shoulder, but that doesn't always happen. What we look at is, once we can identify the neckline, we take the distance from the head to the neckline and project that forward from when the price breaks out, and that gives us our target. Not surprisingly, sort of inverse head and shoulders is the exact opposite. As I said, in a confirmed or in a classical sort of inverse head and shoulders, you would expect the second shoulder, the right shoulder, to be a little bit higher than the first shoulder. Just think about that. Okay, what's that telling us? That's there forming, it's forming basically a higher low. That's what we want to see. It's the start of a new uptrend, and that's what we're looking to sort of position ourselves into. We also talked about double tops and bottoms. Sometimes you might hear them called, M-shaped or W-shaped formations. What we're expecting in an ideal one, that the second peak, okay, shouldn't be any higher than peak one in an M formation. And once again, we see, the sort of that neckline support is broken. That's when we'd be looking to take our trade. And it's the opposite for, double bottom, all right? It's a W-shaped formation. You can see it there. It's very clear. And, ideally, we would be expecting this the sort of second peak to not be any lower than the first peak, ideally. And then invariably, once it breaks out that neckline, that's where we're looking to sort of to take our position long. We also looked at a version of that, triple tops and bottoms. Okay, really, quite self-explanatory there. That's what we're expecting. And once again, it's just about identifying the triple tops and then also identifying the neckline and waiting to see how price reacts once it breaks through. So then, if you remember, sort of, it would have been a week or two ago now, we looked at PO20, the power of the 20-period moving average, as a simple trading tactic for yourself. What we're looking at is, once that market has printed a reversal pattern, then we can use the 20 moving average as confirmation of the reversal. We watch to see how does price react to the 20-period moving average after the reversal pattern. Does the 20-period moving average now provide dynamic support or resistance? Because if it does, well, then we start to get interested. That's when we actually start to sort of give us more confidence that price is reversing and that we should be getting ready to sort of do our business and position ourselves accordingly. We talked about how, For a short trade, okay, when markets are sort of starting to roll over, what we're looking for is that 20-period moving average starts to act as a new roof. We get dynamic resistance. Or alternatively, if we've had a bullish reversal pattern, then what we'd like to see on the 20-period moving average is that 20-period moving average starts to act as a new floor for our longs, and that gives us more confidence. When we see those 20 moving average act as significant dynamic areas of interest, then we have confidence to trade in the direction of the reversal, that confluence of events. Once we've seen that power of the 20-period moving average, then we can utilize any of the price action setups that we'd previously discussed, maybe pin bars or engulfing candles, etc., as a trade setup for us, something that can trigger us into the new trend. So, we talked about a couple of examples here, okay, and let's just draw on here, right? So how you can see price had acted, in a nice uptrend, okay. We had a bit of a false breakout there. Price then fell down, okay, fell down to the 50-period moving average, but as soon as it moved back up to the 20-period moving average has gone from being sloping up to sort of rolling over. It then hits the 20-period moving average, can't close the other side of it, and it also prints a couple of bearish pin bars. That in itself was our trigger, that to actually start to get ready to roll over and take the trade. And if you remember, that's what we looked at on oil there. Okay, just to remind people, we had that price was in a downtrend. We can see that the 20-period moving average had acted as dynamic resistance there. Okay, we had a nice double bottom here. Okay, that's that sort of W formation. Price then got to the other side of 20-period moving average, came back, and now it started to use it as effectively as dynamic support. Prices started from being a downtrend. You can see prices rolling over or started turning before it melts up, and that was basically our opportunity to take a nice trade on the weekly chart there for a good few pips. There's another example that's from the Nikkei that we talked about last week. Okay, just very nice sort of idea. You have a double bottom there. Okay, at a significant level of support. So we're starting to get 3 or 4 things all coming together. Okay, and then once price gets above that 20-period moving average, which is now turned from downside to sideways to starting to point up, well, we can see that actually invariably that we had a few trade setups there that were giving us an indication that the sort of price was about to rise, and of course we would want to position ourselves accordingly. We want to sit and wait and be ready to sort of trade in line with that. So there you go, ladies and gentlemen. We've had a bit of a quick fly through there, some of the sort of the tactics and the trading methods that we have talked about for the last few months now. Okay, lots of different methods. And next week, what we'll do is probably do a little bit of a method review there, sort of just talking about them, where and how we can use those particular ideas that we have shared with you here at Admiral Markets. But what we're going to talk about, we touched a little bit on it, earlier on, is that looking at a thing called the 1-2-3 pattern, right? That's a particular easy reversal pattern that we can see, and it's something that actually provides lots of opportunity for us. So I appreciate some of you who have joined us may be aware of what an 1-2-3 pattern is. Some of you might be completely new on that. Well, I'll just talk about how we can look at it, how we can identify it, and then also we'll talk about different versions of it, rather aggressive versions of it. As I said, I try and share different ideas to based upon the sort of level of experience that we have in our room. So here we have, we've just got a little bit of a chart there. Here, this is a bearish 1-2-3 formation, and the question would be, what is the 1, 2, 3, and where would you sell it? Okay, some of you might be well aware, others might be struggling. So allow me to entertain and educate you. So 1, 2, 3 pattern here, you can see that there, we have price has risen to 0.1, the price then drops away to 0.2. Price then basically from 0.2 rallies up, okay, but it's a little bit like the double top formation, okay, the 0.3 should not be higher than 0.1. And when that actually happens, when we actually get a sort of a double top formation like that, it looks like a 1, 2, 3 pattern, and that becomes a tradable option for us. So the normal convention, okay, just normal standard trading, ladies and gentlemen, is to basically sell on the break of 0.2. That's it, just as simple as that. Sell on the break of 0.2. That's all you're particularly looking for. That's what we're expecting. 0.3 is now a lower high from 0.1, okay? That's what we're expecting. That's what we expect price to continue down. Remember, we're not trying to pick the exact top, waiting for the market to play its hand. Show that it has printed a lower high, which is one of the first indications that a new bear trend is about to take place. So here's a version for if you wish to be quite an aggressive trader, okay. And I wouldn't recommend this to complete new traders. I'd be saying this, this takes a little bit of experience, a little bit of understanding on how the market's set up and how it's running. But an aggressive sort of 1, 2, 3. Well, once you've identified a good line on the sort of 2 to 3 level, that you actually trade when price breaks that sort of 2 to 3 line, which is quite aggressive. It doesn't mean that it's going to turn, but what it means is that if I just get my pen on board here, is whereas normally you'd be looking to sort of be getting short around about here. Well, when it works well, you're getting short here, so that by the time with your stop above 0.3, so your trade risk is very small, and by the time that actually price hits that level where most people are getting in, you're in a position to either sort of take some profit, or you're in a position to sort of move your stocks to break even. You're ahead of the game. So it's quite aggressive, but trading is all about managing your own understanding and comfort with the risk to reward phenomenon. If you wish to have a very aggressive 1, 2, 3, well, what you can do is you can sell on the break of, if there's a high test or a pin bar candle, so long as 1 or 2 other elements line up. This is very, very similar to, if you remember, the kind of key KDR 1, 2, 3 combo we talked about a few weeks ago. Excuse me. It is very aggressive. Excuse me. It is almost like ultra aggressive, and as I said, it's not for everybody. My suggestion would be just try and identify these trades on your charts. Just open a chart of anything, and you'll find that those setups are there everywhere. So what we do is, if 0.3 we get a high test or a pin bar candle, and we have a couple of other elements lining up, then we would look to sell the break. Okay. Break of that candle at 0.3. So it's quite aggressive, but the thing is, we know if it's going to work, it'll work very, very well. If it doesn't work, we know we're wrong very, very quickly. And as I've said before, that's the way I prefer to trade. So, as I said, we want a confluence of events. So, what we might see is that 0.3, could be something like a pin bar, where is it actually also pointing off or bouncing off a particular pivot level, something that we will touch upon in the next few weeks when we talk about sort of market structures. So, it's what it is remember, it's about confluence of events. Okay, if you see that particular pattern starting to show up, and actually you're running into pivot level that also has particular sort of maybe say resistance from other players, well, then that gives you an opportunity to sort of take the trade in line with that and to be ultra aggressive. So yeah, you might have, might be part of a trend line, okay, or a moving average, something that's providing either dynamic or static resistance. Okay, it's once again, it's confluence events. I want somewhere between 2 to 5 things coming together all in one time and place to give me a great opportunity for a trade. Or it might be if you use particular Fibonacci elements, which we've not really touched upon much yet. So it might be that if you're an ultra aggressive trader looking to trade that 1, 2, 3 pattern, well you might see a very nice pullback into the zone between the sort of 50 to 62% fib retrace of the move down between points 1 and 2. So if you're pulled back into that zone, which also is at a pivot or also a trend line, and also has a pin bar or a rejection candle, once again you've got 4 or 5 things all coming together at the same time and place. That's what starts to get us interested about actually looking at seeing that being a place for us to take a good quality trade. Just a little additional element that just might give you a little reminder, ladies and gentlemen, is that the traders that edge on a 1, 2, 3 is that 1, 2, 3 could actually be a double top, which I think I might have mentioned a little bit earlier on. And remember, it could be a double top. So what we're expecting is that once again, 0.3 does not go any higher than 0.1. That's what we're looking to do. That's what we're looking to identify. That is where we're actually sort of looking to do our business, and you could be looking at that once that price has broken the trend line, or if it's printed a good sort of rejection candle there at 0.3. Well, that gave us an opportunity to do our business. So that was we looked at bearish formations there. So, but of course we have bullish formations as well. And if we look at how would we describe a 1, 2, 3 formation? Well, where would we look to buy? Well, it's it's just pretty much the exact opposite of a bearish 1, 2, 3. So maybe price has been in a downtrend, it moves to 0.1. Price then rallies up to 0.2. Okay, there's sort of less people trying to sell the market. They sell it from 0.2. Okay, and what actually happens is we go down to 0.3. And then we see price starting to turn around. When price starts to do that, okay, we know that the downtrend is over, and actually what's more than likely to happen is that price is going to sort of rally north. And when it does that, we want an opportunity to get on board and take a trade with that. So in the same way like the bearish 1, 2, 3, standard convention is that what you do is once you've identified a valid 1, 2, 3, is that you would look to break the sort of break price trading through the 0.2. And there's absolutely nothing wrong with that, ladies and gentlemen. Okay, I will use it myself in some of my own trades. Absolutely nothing wrong whatsoever. Nothing wrong at all. A lot of this is all about understanding your own risk to reward profile. That's going to be part of our big sessions over the next few months. All right. So Paul, I can teach you quite a lot of technical trading ideas. Okay, I can teach you plenty of them. But what really you have to understand from yourself is about understanding your own risk parameters. Okay, how accepting of risk are you, or how averse to risk are you? There's no right or wrong to that question, ladies and gentlemen. It's just about knowing who you are and how you can utilize that to help you. So, if you want to sort of trade an aggressive version of well, then actually once you've identified the sort of 0.2 to 3 and you're able to draw a line there, well, then actually a buy on the break of that 2-3 line. Okay, when you stop beneath 0.3, that becomes quite opportunistic. Okay, but it's a great opportunity to take a long trade. Okay, and once again, some people will look at that and say, actually, that's not for me, and that's fine because that just shows their adverse nature. Other people would be looking at that saying, that's exactly where they want to get because it gives them sort of a very aggressive opportunity to get long early. And then, a sort of another version of it, another aggressive version of it is that, you can buy on the break of the reversal candle at 0.3. That could be something like a hammer or a low test rejection candle or a spinning top, something that gives you an indication that price is about to reverse and reject that level. And that what we actually also have is a higher low, and that's giving us an indication that price might reverse and start a new uptrend. So there you go, ladies and gentlemen, just a quick insight into sort of trading the 1, 2, 3 pattern. What we'll have is we'll have a look at the charts in a moment, start to identify a few of them, look at seeing how we can build that into our own trading. As I said, just like every week, just take these ideas and just go and practice, go and use them tomorrow in your own trading. Have a look at how you could use them. Just practice being able to see them across all sorts of time frames. Practice you being able to identify, where your entry point is, where your stop loss would be, what was the element of in terms of what was your trade risk, how much did you risk, what were you looking to sort of gain in terms of reward, because do all of that, take some good data, because that starts to give us fantastic information about what type of trader you are. And that's what becomes much more important when we start to focus on the 4 M's of trading in terms of the managing myself bit. So, what we've also talked about is, I appreciate that the last few months we've been quite caught up in the academics, so to speak. And what we're looking at is, what we're going to do is open up a profile, okay, on our MetaTrader platform and start to create, mastering 4M's profile. But within that, as well as the dollar index, which we need to sort of watch like a hawk these days, we also want to sort of add in the kind of major sterling and European currencies. That's, so things like pound dollar, pound yen, pound Swiss, pound Aussie, pound CAD, pound Kiwi. And then on the euro side, euro sterling, euro dollar, euro yen, euro Swiss, euro Aussie, euro CAD, euro Kiwi. Okay. So you can add them in, all right? That gives us 28 major pairs of the FX, okay, as well as the sort of the dollar index itself. You can also have a little look at some of the instruments, okay, indices, the S&P 500, the Dow Jones, the Nasdaq, the FTSE, the DAX, and the Nikkei. Commodities-wise, let's focus on things like oil, gold, and silver for us to sort of look and trade and master in the 4 M's of trading with. Then also to have a particular look at some equities. I know that some of the people who join me here, they are more concerned about equities, and you can look at, we've talked about things like the FANGs, okay, the sort of tech stocks, but with the market movements we had over the last sort of 4 to 6 weeks, there's certainly been some opportunities within equities, and I hope you've been able to enjoy them. Finally, I know that some of the people who work and trade with Admiral Markets are very interested in trading cryptocurrencies, and invariably Admiral Markets now offer a fine range of cryptocurrencies: Bitcoin, Ethereum, Litecoin, and Ripple. Okay, there is just to name a few, as they look to sort of try and misplace or displace rather the sort of almighty US dollar. So, ladies and gentlemen, remember the big picture, okay? That's what we like to remind you of every week, okay? When we go through some of the slides very quickly, remember to manage those 4 M's of trading. Markets, method, money, and myself. How do they do that? How do people do that when they're, maybe not feeling in alignment? Well, actually, this is the interesting thing, is that, they would look to sort of understand those 4 M's, make sure that you're constantly testing yourself, checking yourself against them to sort of confirm that you are in alignment, that you're managing all 4 of those. Because when you are, as I said right at the start, when you're managing those 4 M's well, that is when you tend to be more successful as a trader. So there you go, ladies and gentlemen. If you're watching this, today, or if you're watching this on demand and you've got questions about this or the Admiral Markets offering, well, then by all means give them a call on that London number 020-7726. 4003. You can get in touch with them at email at hello@admiralmarkets.com. You can go and watch and register for their YouTube page, youtube.com/Admiral Markets. And also you'll find that on Facebook itself, they have an Admiral Markets global page. So be sure to check all of them out. There'll be some interesting slides and elements on there. And as I said, you can also get an opportunity to talk to your account representative. So there you go, ladies and gentlemen. We've got a few minutes here. Okay, so maybe we'll just have a quick look at some of the charts for the last couple of minutes. Hope you found that useful. I hope that you can see the way that a 1, 2, 3 pattern can be used on itself. But remember, we also talked a couple of weeks ago about using it as a combo with a key day reversal, and that's what I want to try and get across to you. That a lot of it is to do with a confluence of events, and being able to identify and bring that to bear makes for a good trading session and for a good trader itself. So there we go. I've just brought up some charts here. Okay, I was doing a little bit of work on the euro sterling there. Okay, so in preparation for tomorrow, we've had a little bit of a turnaround there, which is nice for me. Nice to see that on our trades. And we just have the opportunity to sort of look at some charts and sort of understand what has been particularly going on. We look at the kind of dollar index. That's our first major go-to. And if I look here, okay, what I'll be looking at here on the dollar index. This is a weekly chart here. I'm just going to draw this in for us. Is that here we go. Let's just draw 0.1. Here we go on the weekly. Just so you can actually see without it cluttering up all of my charts there. Okay, so we had 0.1 there. If the price had been in an uptrend, okay, we had 0.2 down here, and then we actually had 0.3 here. Okay, so here we go. Yep. Oops. There you go. Hopefully you can see that, there we had that 1, 2, 3 pattern. Now, of course, as I said, the very, sort of, aggressive young trader might have wanted to sort of just try and trade the break of that candle there, the break of the trend line. Okay, that gives an opportunity to sort of get on board. I kind of, it's a nice little setup there. Okay, nice and easy little setup. We also have the same here, okay, a little bit of a scruffier version of it. So let's just move these around. Let's just put this in place. Okay, this is super. Okay, well, so there you go. You can see there, just on there, there's just like a couple of little 1, 2, 3 patterns there. We talked about here on the sort of on the Dow, but also on the S&P. Let's have a little look here. Okay, we can see that the Dow is actually having a bit of a bad session there this morning. Okay, not looking too well for not looking too well for itself. But if we look at, let's say, the S&P 500 on the daily chart, okay, what we can see is that actually what we looked at here was the double top here, and we saw after a nice uptrend, and we saw price break it and then actually sort of fall away. The reason I bring this up is because it shows a double top formation, which is also a very nice 1, 2, 3 formation, but it also shows that the guy had been in the Air Force during the First World War, and actually we looked at seeing how these 1, 2, 3 patterns were able to sort of be traded going back as far back as that, and it was just a case of being able to sort of identify that double top. We can see 0.2 there. Okay, 0.2 is where most people would normally trade, and there's nothing wrong with that. But also, the sort of aggressive traders might have just drawn a line there between points 2 and 3 and traded that. Ultra aggressive traders might have just traded the break of 0.3 straight away as well. So we can see that there was like some kind of nice, interesting double top, which was also a 1, 2, 3 formation, which gave us a couple of opportunities to get on board that before it actually fell down very, very nicely indeed. So there you go, ladies and gentlemen. We'll draw it to a close there. I hope you found that useful. I hope you found that interesting. The recording will be in the archive over the next day or two. Use that as an opportunity once again. Just go away, pull up some charts. Doesn't really matter what it is. Have a look at them and start to identify where you can see those 1, 2, 3 formations occur. They occur everywhere. And be able to look at, how would you feel in terms of trading just a normal setup, or actually trading an aggressive setup, or actually looking to trade, the sort of ultra aggressive version of it. I say that it's as always that just take your time, okay? Just go away and look. As I said, I always want to give you ideas you can use tomorrow in your own trading. So just take away, have a look at them, just spend the rest of the week trying to identify it and work with it before we do our next session next week. So Phil Hansius come on there and said, "Great as ever, Paul." That's very kind of you, Phil. I appreciate that. Thank you for joining us. Okay, thank you for joining our sessions over these last few weeks. Hopefully, with the Admiral Markets Mastering the 4Ms of Trading webinar session, you're getting a little bit of education and also a little bit of insight into the various ways that you can engage with markets. So as always, I wish you the very best of success in your own trading. Hopefully some of you will join me tomorrow for the Tuesday morning, London 10 a.m. real-time daily trading ideas, and I look forward to speaking to you then. Until such time, trade well, ladies and gentlemen. Thank you.